How's it going, everybody? I apologize. We had an error, but we fixed it. I am here. This is extremely embarrassing, but we were actually all just in a different room having a conversation with each other, and we thought we were live, but we weren't. So a little bit of a technical error there, and I apologize. If you guys can see me, if you guys can hear me, can you please let me know in the comments? And again, I am very, very, very sorry. But we're here. The other guys are coming in. We're slowly going to make this happen, and we're restarting. How you doing, Taylor?
Good.
We're here. We're making it happen. We lost a good amount of people because we were not on time. But, I apologize, guys. Thank you, Allison, for letting us know you can hear us. How you doing, Dave? How you doing, Robert? How's it going, Ian? Thank you, everybody, for showing up here. Annie as well. So, Taylor, can you make sure Brandon gets over here? So, Arul, appreciate you, man. Always appreciate you. Good to see you. Always here. So, guys, we are here today to talk about the STR tax loophole. We were just talking about it for 5 minutes between the three of us, without in front of anybody else. But we are officially here. We are going. We're making this happen. And we are bringing in Brandon Hall, who is from Hall CPA. He is the go-to guy when it comes to real estate and taxes. And so we're going to be talking about all of the do's and don'ts of the short-term rental tax loophole with one of the best experts in the entire industry to be able to talk about that. Thank you, Dan Burke, for letting me know you got us. All right, guys, we're just going to keep waiting. So I'm going to do a little introduction. And I'm going to calm down a little bit because, I was trying to scrambling there for a minute, knowing that you guys were all waiting for us. I'm going to calm down for a second, take a little breath. But my name is John Bianchi. I'm the Airbnb data guy, and I live and breathe Airbnb data. That's what I do all day, every day. I absolutely love it. I am absolutely obsessed with it. And I like to believe that I'm pretty good at finding profitable properties. And so, Brandon, how you doing?
How are you?
We had a little bit of a hiccup there, but we're making it happen. We had 60 people over here waiting for us, and we're just all, talking to each other. All right, guys, I'm gonna shut up now. Taylor, why don't you give yourself an introduction? Brandon, why don't you give yourself an introduction right afterwards? Okay.
Sounds good. Taylor, head of acquisitions, been a part of helping investors acquire over 180 cash flowing Airbnbs in the last 2.5 years. Acquisitions and data go yin and yang. I've been blessed or cursed by having to talk to John every other day, if not every day, for the last 2.5 years as data flows right into acquisitions. Yes, my wife will joke that I probably talk to John more than I do her, but that comes with the territory. So we're always using data to make very accurate decisions. As a washed up baseball guy, looking at numbers and staying very disciplined to them comes naturally to me. So being able to underwrite, stare at pro formas all day is something that most don't enjoy, but I somehow really enjoy doing on a day-to-day basis. So Brandon, I'll let you take it from here.
Yeah. Thanks, guys. Appreciate you inviting me to be on this. My name is Brandon. I run Hall CPA, which is a national tax and accounting firm. We provide tax prep and planning services, as well as outsourced accounting services to real estate investors across the United States. We currently have about 1,300 clients. We work with investors that are primarily in 3 categories. So category 1 is I'm earning really good income and I want to buy my first couple of rentals. Category 2 is I've got a real estate business or portfolio that's already pretty established and need some tax consulting to further optimize. And then category number 3 is general partners of syndicates and funds. So the guys and gals that are raising millions of dollars to go and buy large buildings, commercial, apartment, mobile home parks, all that type of stuff. We see it and we consult on it. That's me.
That was the second time around giving that introduction, and I think it was a little bit better than the first time. So, not that the first time wasn't good, but
practice is perfect, right?
Yeah, there you go. Brandon as well, guys. Just so you know, he is all over YouTube and Twitter. Your YouTube videos are awesome. Just want to say, very informative. And from my understanding, I'm not on the Twitter world, but Taylor is, and he tells me that you call people out left, right, and center.
I do, yeah.
Yeah, that is. We love that over here. Calling out the people who don't actually know what they're doing and are talking on stuff just to get the clicks.
There's a lot of them.
There's a lot of them. Yeah,
it's a full-time job in and of itself.
The tax advice that is being given out on TikTok and Instagram, you will commit a lot of tax fraud. And so as somebody who's not big on TikTok or Instagram, it is very funny to have Brandon copy those videos and give the accurate assessment. So I think it's not just what do you need to do, we talk about the do's and the don'ts. What I really appreciate about what Brandon puts out from a content standpoint is a lot about what not to do. You know, everybody will tell you what to do to take advantage, but I do appreciate Brandon bringing that alternative lens of, hey, please don't do this because you don't want to get in trouble with the IRS.
Yeah.
Well, and especially when you're talking about like real estate related taxation, it's very easy to say from a macro perspective, here's what you should do, but there's a ton of nuance. And I try not to be like the classic CPA that just tells you no all the time. So I try to take like more educational approach. Like, yeah, like this is the big idea. However, there's a million little things that you have to know. So anyway, yeah, there's a lot of no, you can't do that. No, you can't do that. No, you can't do that types of conversations.
which is good. I feel like, you know, I'm kind of that person as well when it comes to the data, where I'm constantly poking holes in every single last thing that people are showing out there. And like Taylor's the exact same when it comes to underwriting. Like his blood boils if you put out an underwriting sheet where it's inaccurate. If you're showing like less than $60,000 in renovation, construction, furniture, and all this different stuff, he's like, in what world are you putting that much money towards all of those things and still hitting like the top 10 percentile? You're just not, you know what I mean? You're not cash flowing. So anyways, with that being said, guys, we got 74 people live right now watching us, which is amazing. And I'm just going to let all 74, now 72 of you know that I am a Canadian, if you did not know that. And I cannot use any of the STR tax loopholes. So you Americans have it so good, you don't even understand, all right? I know there's a lot of issues with America right now, but it's a lot better than a lot of other places. And I'm saying that simply because I actually am kind of an idiot when it comes to this stuff. I have a general understanding of it, but I don't understand it extremely well. Taylor understands it a lot better. Taylor is going to be the semi-expert here, and Brandon's going to be obviously the extreme expert, and I'm going to be the guy who doesn't know anything asking the stupid questions. So I'm probably going to do the least amount of talking, but I'm just stating that because I'm sure there's a lot of other people in the audience right now as well going, I don't know these things at all. And so we're going to go from beginner to intermediate to expert. All right. But I'll let you guys take it away from here. Taylor, let's talk about how to save $50,000 with the STRs. And should we just hop over to the next slide?
Let's do it.
Let's do it. Let's get going, guys. All right. What is the STR tax loophole? Brandon.
Yeah. Okay. So I'll try to explain this succinctly as possible. When you invest in real estate, oftentimes the rental real estate is going to produce a tax loss, even if net operating income is positive. So what is net operating income? That's revenue minus your actual expenses, right? So forget debt service, just revenue minus expenses. That's your NOI. And let's just like keep it super simple. Assume that you're buying property all cash. So NOI also equals cash flow in that situation. You can have positive cash flow from a rental, but still tell the IRS that you actually lost money. And the reason for that variance is a concept called depreciation. So every single year that you own property, you get to depreciate the property. It's true that properties increase in market value, but it's also true that the components that make up the property quite literally fall apart over time, right? The roof falls apart, the windows fall apart, the appliances, the flooring, everything falls apart over time. So depreciation is an annual expense meant to track that deterioration over time. So you can have positive cash flow, but once you factor in that depreciation expense, which is just a tax adjustment, it's not like an actual expense that you have to pay for every year. So I earned money, cold hard cash hit my pocket, but I can still tell the IRS that I lost money. So what happens with landlords is you'll buy rentals, you'll have the cash flow coming in, but then when you prepare your returns, it's going to show that not only did we eliminate tax on the cash flow because of depreciation, but we also, once we factor depreciation in, have a tax loss. Then the question becomes, can I use the tax loss to offset my W-2 income, my business income, any other type of income that I might have coming in? And to answer that question, you have to go to the passive activity loss rules or the passive activity rules. And everybody's subject to the passive activity rules, but we don't find out we're subject to them until we own rental real estate. Because the passive activity loss rules prevent you from using those tax losses. So let's come up with a number just to carry this all the way through. Let's say that our revenue was $10K, our expenses were $8K, so our cash flow is $2,000, but our depreciation expense is $5,000. So we made $2K. That's cold hard cash that hit our pocket, but after depreciation, we actually lost $3,000. At least that's what we tell the IRS. So can we use the $3,000 to offset our W-2 income? The answer is going to be yes, if I qualify for an exception to the passive activity loss rules. But if I don't qualify for an exception to the rules, then the $3,000 is suspended and it's carried forward indefinitely until I generate passive income or sell one of my rentals at a gain and can unlock those losses. So the question is, what are the exceptions to the passive activity loss rules? There's a couple of them, but the most well-known one and the most targeted is real estate professional status. But real estate professional status requires that you spend more time working in real estate than you do at your W-2 job or running my CPA firm. So because I run my CPA firm, and because if you're listening to this, you work a full-time W-2 job, you cannot qualify as a real estate pro. You can try. You're going to lose in tax court, though. A lot of people have tried to say that they spent more time in real estate than their W-2 job, and not a single person has won, as far as I'm aware. So what happens is people they connect the dots and they go, okay, wait a second. So if I buy rental real estate and it produces a $3,000 tax loss after depreciation, even though I'm making money, I have this $3,000 tax loss that I can't use. If I do this 10 times, now it's a $30,000 tax loss. And you're telling me I can't use it. It gets suspended, carried forward. Why would I invest in real estate? There's no tax benefits for me, right? That's the conversation that we have. And it's partially true, partially untrue. But the kicker is that tax loss does get suspended and carried forward because you can't qualify as a real estate pro. So the workaround is to buy short-term rentals. And the reason that this is a workaround is real estate professional status applies solely to rental activities. But there's a regulation that says that as long as the average period of customer use of your short-term rental is 7 days or less, it is not a rental activity. So if I don't have a rental activity, I don't have to worry about qualifying as a real estate professional. And the significance of that is, again, real estate professional status requires that I spend more time in real estate than I do anywhere else. But I don't have to qualify as a real estate pro. I don't have to worry about spending more time in real estate than I do my W-2 job or my business. I just have to make sure I materially participate, which we can get into. But as long as I meet a material participation test, and as long as my short-term rental, the average period of customer use is 7 days or less, that $3,000 tax loss is now non-passive. And that means that I can use it to offset my W-2 income or my business income. So that was the 120-second version of the short-term rental loophole.
I love it. And what's hilarious is, despite what your favorite guru tells you online that buying Airbnbs is passive, the IRS will correctly tell you it is an active activity, and you can use those losses to offset active income. So I do always find it hilarious that we have this great tax advantage, and the IRS has established that, yeah, operating these things is an active classification. It is far from passive. Yet your favorite Instagram or TikTok bro might tell you, oh man, Airbnbs are passive. So always hilarious to see the contradiction from the technicality and even what the government is telling us and what your favorite online guru is. So Brandon, thank you for that definition. John, wrap us up on the slide.
Yeah, before we hop over to that next slide, we actually have two people that reached out almost automatically when you stopped talking and asked about the 7-day rule. If you can explain that one more time before we hop over.
Yeah. Okay, so the passive activity loss rules say that there's two types of passive activities. One, any rental real estate is passive unless you qualify as a real estate pro. Two, any trade or business that you do not materially participate in. So if we look back at definition number one, and I should use the right term, any rental activity is passive unless you qualify as a real estate pro. The question becomes, what's the definition of a rental activity? Okay. Because if I have a rental activity, then I have to be a real estate pro. And now I have to spend 750 hours working in real estate and more time working in real estate than anywhere else. Those are the two rules to qualify as a real estate pro. So I got to figure out what the definition of a rental activity is. And when you go to the regs, these are all in section 469. So when you go to the section 469 treasury regs, you see what the definition of rental activity is not. Okay. So it tells you if your average period of customer use is 7 days or less, you do not have a rental activity. So then if I go back to the passive activity rules where it says all rental activities are passive unless you qualify as a real estate pro, but I don't have a rental activity, basically just get to cross that rule out. And now I'm bouncing down to the second rule, which is material participation. So I have to materially participate, but it's 7 days or less. And that's average, by the way. So you could have one person stay for 30 days, and then you could have 30 people stay for 1 day. And I actually should not have used those numbers because I cannot do that math.
Good math. Yeah, I was going to say there's live math. Yes, I do know that is your average length of stay. Your average length of stay. Yes, you can take a 10-night booking and then you get a bunch of 2s, 3s, 1s mixed in there, and your blended average for the year is a 4.2 average length of stay. I'll tell you, if you're focused in on short-term rentals, the most common booking is a Friday night check-in, Sunday checkout. That's 2 nights. I can tell you historically, most single family homes, even condos will be even less for couples. They'll come in for a lot of 1s and 2s, but even big groups, the most common you see is a lot of 2 to 4 night averages. So you're not really even flirting with that 7-night average unless you start taking those 30-day snowbird bookings type of thing. Then you could start rolling the dice a little bit and getting close to that average for sure.
Yeah, and we see that with a lot of our clients as well. I know that there's some discourse that's like my clients never get below 7 days, but we look across our client group and it's not really a problem because most of those rentals are 3, 4, 5 days. Even at like beach properties and mountain homes, you're typically booking 7-day rentals, and then in the off season you're booking just a handful of days, so you're going to be below 7. No problem. But it's equal to or less than 7. So it could be 7 right on the dot. But if it's 7.01, you're toast. So you do have to manage that effectively. But the big thing, the big idea is if I've got $200,000 to invest in real estate and I'm working a full-time job and my wife works a full-time job, neither one of us can be a real estate professional. I can go and I can buy commercial space. I can buy multifamily. I can buy single family. I can go that route, right? I can fully invest my $200K, and in the losses that all of those properties generate after depreciation, I'm not going to be able to claim, right? It's just going to get suspended and carried forward indefinitely. But if I instead bought a short-term rental, and now I have my 7 days or less is met, and I do materially participate, which is not as challenging as you might think, then I can use the tax losses to offset my W-2 income, even though I work full time. And then when you think about the power of a cost segregation study and bonus depreciation, even being at 60% bonus this year, we're talking about a pretty significant tax loss. You can easily get into 6-figure tax losses that I can claim immediately against my W-2 income. So what we saw, we actually, back in 2020, we wrote this big, long article about real estate professional status. It's like we ended up making it a downloadable ebook as well. It's still on our website, but if you download it, it's like 30 some pages. That's how long it is. It's fully cited, all the tax court cases, everything, because I got tired of fielding questions from prospective clients, and then those prospective clients saying, you don't know what you're talking about, when I told them, no, you can't go and just research on the MLS for 8 hours a day and qualify as a real estate pro. It doesn't work like that. So finally, I just documented everything. But then through that process, realized, oh, wait a second, if you buy like an Airbnb or VRBO type property, you don't even have to do all this. And so then we went and we started publishing a lot of content about the short-term rentals, and all of the gurus, tax gurus that you see now actually copy all of that content, which is so funny. But that's fine. That's fine. More information out there for everybody. But the challenge that we have ended up trying to help our clients through is, you see people hate taxes, like just hate taxes. I don't know. I mean, I get it because I'm a tax guy. I also pay a ton in taxes. But like, I don't hate taxes as much as some of our clients hate taxes. Like they will say, I want my tax bill to be $0. I want my 50K back $0. And it's like, well, is that the most efficient thing to do? And typically the answer is no, but that's a different story. But what happens is, when you're buying these short-term rentals, if you're in it for the tax reasons, you're toast. You're dead before you even start. And we saw a lot of people in 2021 and 2022 buy property in Joshua Tree, in the Smokies, various cities that now have cracked down on Airbnb rentals. And yeah, sure, they got the tax benefits. That's great. But you still have to operate the actual short-term rental, which I know is where you kind of come in, Taylor, on that acquisition side. So we really try to encourage our clients, like, yeah, the tax benefits are amazing, right? This is a serious, awesome, legitimate thing. However, did you actually underwrite the property for like wealth creation? Let's start there. And you'd be surprised at how often the answer is like, oh, I'm just in it for the tax benefits. And it's
We've even seen the same thing. We had a client reach out to us, high income earner, didn't know what he was doing. 2021, bought an Airbnb, he said about 60,000 in tax losses. Great, high income, works in tech. And then we were like, well, how's the Airbnb doing? I lost 15,000 a year. So just from the business side itself, you go, cool, you're a net 45 in year one, but you're not able to extract that 60,000 in year two. And now all of a sudden on a 3-year chart, you go, well, the Airbnb is losing 15K a year. So what I tell people is the tax benefits available, whether you buy a good Airbnb or bad, but you might as well buy a good one that's cash flowing and building wealth versus one that loses 15 grand a year. And that's, I think, something you really hit on. You've said the term material participation a couple times, which is kind of leading into, the next slide here, John.
Well,
so
we're going to hop over to the real estate professional status first.
Perfect.
And get going from there. But Brandon, just want to call out that the number one thing I wanted to talk to you about was people getting into real estate for the tax savings and not wealth building. That was the number one thing I had in there, and you already brought it up. So we'll definitely get into that a little bit more, because I do see that being one of the dumbest things that very smart people do that make a ton of money, right? And they're like, oh, it's fine if it breaks even. If your goal is for the property to break even, you're going to lose money.
Well, and there's a tax bite on the back end of it too. It's depreciation recapture. So I want to talk about that whenever we get to that section.
I'll make sure we'll bring that up probably a little later. But just want to mention, we are 21 minutes in, and I forgot to mention this at the very beginning, but Brandon actually has a 4-day training that he is going to be giving away. It comes through in an email every single day. You're going to get another piece of that training. And if you stick right to the very end, we'll give you the QR code you can sign up for and get that going, so you can learn all of the little details. And then on top of that, Brandon's also going to be giving the list of how to materially participate for the short-term rental tax loophole. So he's got a whole list, and he's going to share that with you as well, likely at the end or through an email. So stick to the end, and you'll be able to get those things, okay? But for now, let's hop over to the real estate professional status, which you've mentioned a couple times. Our next one we're going to go into, guys, is material participation. But let's start off first here with the real estate professional status. Take it away, Brandon.
Yeah. So when you buy real estate, you're subject to the passive activity loss rules, and the passive loss rules came into effect in 1986. And the whole intent was to stop rich people from buying real estate and using losses from the real estate to offset their regular income. So the passive activity loss rules go into play in 1986, and they say that all rentals are passive, and if you don't materially participate in a trade or business or in an activity, then it is also passive. And all of your other income is non-passive. So essentially there's like 2 types of passive income: rentals and any business that you don't participate in actively. And all your other income is non-passive. But they went further and said, if you have losses from passive activities, remember, rentals and any business that I don't materially participate in, if you have losses from passive activities, you cannot use those losses to go and offset your non-passive income. So starting in 1986, I could have all this W-2 income and business income, all these rental real estate losses, and I could no longer use the losses to offset my W-2 and my business income. Fast forward to 1992, 93, something like that. Real estate professional status was added to the Internal Revenue Code because landlords people that were running real estate businesses, such as what you guys do, or flippers or developers, they also had rentals, but they couldn't use rental losses to offset their income from those businesses. So there was this inequity there. It's like, if I'm already in real estate, I should be able to use this real estate tangential tax loss. So they added real estate professional status to the code. And again, real estate professional status says if you spend 750 hours working in a real property trade or business, there's 11 real property trades or businesses. You do not have to be a landlord. You could be a property manager. You could be a real estate agent or broker. You cannot be a mortgage broker. I saw that in the chat. So a mortgage broker does not qualify for real estate professional status. You could be a developer, redeveloper, flipper, wholesaler. There's a whole bunch of things that you could be to hit the 750 hour test. But you have to spend 750 hours in a real property trade or business, and more time in those real property trades or businesses than you do anywhere else. So the 750-hour test is basically a threshold of you have to put some work forward, right? The more time in real estate test is basically if you're working full time in a non-real estate business like a W-2 job or like me running a CPA firm, zero chance that you can qualify as a real estate pro. So they tried to block essentially everybody that was doing that. So the theory is if I work in real estate primarily full time, I'm a real estate professional and I can get around the passive activity loss rules as a result, which just enables me to take my rental losses against my income. So that's kind of the down and dirty on real estate professional status.
Brandon, I know the biggest hack a lot of married couples do. The husband is the W-2 earner. He obviously cannot qualify. You've seen this played out where a lot of people get the non-working stay-at-home wife to rep status. Yeah. Talk about this strategy, because a lot of people I see are leveraging this and using it correctly, and it is a huge hack for married couples.
Yeah, it's a huge hack. So the cool thing about filing joint tax return does not work with separate tax returns. You have to file joint. But if I file a joint tax return, if one spouse qualifies as a real estate pro, then the tax return as a whole is effectively a real estate professional status tax return. So what that means is I could be making $1 million in my W-2 job. We could buy a bunch of rentals local here in Raleigh, North Carolina. My spouse could go and manage all of them and self-manage them and do a significant amount of work, qualify as a real estate pro. We could cost seg all the rentals that we're buying, boost the depreciation, boost the tax losses, and use those tax losses to offset my W-2 income up to the excess business loss limitations, which are new as of, I think, 2022. We're not going to talk about those, but there is a cap on the total losses that you can claim against W-2 income, regardless of real estate or not. But the point is that, yeah, if one spouse qualifies, then you can absolutely leverage it. Now, I will say that your spouse has to actually want to do this. Okay. So, we have, it's always funny because I feel like I've built this reputation online now of just this like no BS. We'll optimize your stuff, right? We're going to do everything we can to reduce your tax bill and make sure that you are optimized. However, I'm not taking any of your crap at the same time. And we get people every once in a while who's like, I cannot believe that you wouldn't let me log into my spouse's Gmail and send all of the emails on her behalf and count that time towards her hours. It's like, dude, all right, first off, do you hear yourself? Second off, you just put that in writing, right? We don't have attorney-client privilege here, man. Like that's evidence, man. So anyway, it's just, your spouse actually has to want to do the stuff, right? Otherwise, you're just setting yourself up for failure.
Yeah, I have seen where the husband is tired of paying taxes and tries to drag the wife in. But when you do get that wife that does have that desire, looking at it from a holistic approach, it is a pretty powerful tool to get that joint taxes and rep status. So reps being way more difficult, material participation, as you kind of teed up at the beginning, being the simpler, more straightforward approach here. What is material participation and how can a lot of clients who are doing this take advantage here?
Yeah, so material participation is basically continuous and substantial work on a property, right? So you are actively involved on an ongoing basis, and you're doing more than what we would call investor level activities. So you kind of have to think in your mind, if I were to buy a property, what would I have to do to make sure that property produced? But also, if anybody else bought a property, what would they do to make sure that property produces? And so typically you're going to come up with things like, well, we got to pay the bills. We got to prepare tax returns. We have to do the bookkeeping and review financial statements. The problem is all of that type of activity is what they call investor level activity. Any investor would do those things to make sure that their investment performs. So investor level activity does not count for material participation unless you are managing the day-to-day operations, meaning you don't have a property manager, right? So if I don't have a property manager and I'm managing all the day-to-day stuff, and I can do this from a distance, it's more challenging to do from a distance, but I can do this from a distance, then I'm involved in the day-to-day operations. And then all that investor level time can count towards material participation. So the way that I like to frame material participation is there's 3 buckets of hours that do not count for material participation. So investor level time we just talked about. The second bucket is education and research time. So a lot of people think like joining this webinar, for example, counts as material participation time. But the answer is no, it does not. People think that if I go to like a big real estate conference, I heard a CPA say that you can go on a real estate cruise and count that time for material participation, and that is totally false. You can't count this what I call BS hours as material participation. You actually have to be swinging the hammer. That's the type of time that's going to count. And I'll go over a list here in a second. But education, research time, that's very fluffy time. It's very squishy time. If I do that time or don't do that time, it's highly likely that the property is still going to perform as if I didn't do any of that time anyway. So that's like your litmus test, by the way. That's our litmus test is, if you do this time, does your property significantly increase revenue? And if not, then the time doesn't count. So listening to the Tax Smart REI podcast, which is our podcast, does not count for material participation time. You actually have to be there at the property, rocking and rolling. The third bucket of time is travel time. So travel time is not going to count for material participation in most cases. The exception being that the properties are all local to you and you're visiting them on a consistent, i.e. weekly basis. You're self-managing them, so your travel time is required essentially to be there. Otherwise, your travel time is not going to count. And this is a bummer for people that have like I have an Airbnb that is 2.5 hours away from me. I visit it a few times a year to do some repairs and upgrades. Travel time is not going to count, right? Because it's infrequent. It does not impact the day-to-day operations. So investor time, education, research time, travel time, that's the time that does not count. But I do have a slide on the time that does count. If I can share my screen, you guys good with that?
Oh yeah, for sure. So you're just
All right.
going to have to load it up. Once you have that ready to go, bring it to the front of the stage. We'll remove this from the front of the stage. We'll add that in there. There you go.
So let's go find this. There you go. So on a short-term rental, material participation is going to be self-managing the bookings, communicating with guests, taking photos for your listings, posting your listings on VRBO and Airbnb, collecting rents, calling and coordinating with cleaning crews, walking through the property to inspect it, performing repairs yourself, cleaning the units yourself. And when you read this list, it kind of sounds like a property manager, because that's what you're supposed to do, right? So that is material participation. If you are the one that's managing the property, then you've got a good chance of being able to qualify for material participation. Now, the pitfall is going to be something like, oh, posting my listing on VRBO took me 10 hours, right? Yeah, you're laughing. Now, when this came out, when we first started doing short-term rentals, like back in 2019, 2020, and we were taking these time logs in, and that's one tip, by the way. If you're listening to all this and you're like, wow, that's like a lot of time, you have to track all this on a time log in order to substantiate it. You have to prove, right? With the IRS, if you're audited and then you go to tax court, you are guilty until you prove your innocence. And so you need to start developing evidence today if you're going to be running any of these strategies. But one of the things that you have to do is keep a time log to prove when I went to the property, how much time I spent, what I did. So anyway, I would get these time logs, and I remember one of them said that they spent 10 hours setting up VRBO. And at the time I was like, oh yeah, that makes sense. And then I went and I bought my own Airbnb, and it took me, 30 minutes to do pictures, 45 minutes to actually get it set up and rocking and rolling. I integrated price labs, all set. And then I was like, man, this guy's like scammed me. So anyway, you can't lie on your time log. That's the point. If you're trying to inflate your time log, the IRS will absolutely sniff it out if you're audited. And there's tax court cases where they'll actually go into the time log, because the tax court's trying to figure out, when they're trying to make a ruling, right? They're looking at you versus the IRS, and they're trying to figure out, are you credible? And so when you put that it takes you 24 hours to replace blinds or 2 hours to send a 1-sentence email, they'll actually go through the time log and try to figure out, like, is this person just inflating all their hours? And if you are, you lose, and you lose all the tax benefits. You owe penalties and interest and back taxes. So you do have to be careful when you're saying you're doing the things that you're doing.
Brandon, I have a one that I would be super curious about. So a lot of people talk about you got to order all the furniture. So you're on the home stretch. Your Airbnb's been renovated by contractors. The designer made it look nice. You've got your beds, bed frames, couches, sectional dining table. It's all shipped to the property in boxes. It looks like a mini Amazon warehouse. Now you're going to go to the property and set it all up. I know you talked about travel time, but what about you talk about swinging hammers, that you are literally swinging hammers, hex wrenches, putting bed frames together. How is setting up the property classified?
Yeah. So if you are self-managing, then you're probably fine. If you have a property manager, there is a decent chance, and it just sort of depends on your facts and circumstances. That's why I'm kind of being non-committal here. But there
Love
is
it.
a decent chance that the setup time will be considered investor hours. So, like a lot of people will think, well, I spent a whole bunch of time ordering fixtures, coordinating with my title attorney and my mortgage broker and my real estate agent and my property manager. There's a whole bunch of due diligence and setup that has to go into play. But we go back to that like simple litmus test of, would any investor do that? And if the answer is yes, then those are investor hours, and the investor hours only count if you manage the day-to-day of the day-to-day operations of the rentals, of the rental once it's in play. So the real question on that is going to be, do you or do you not have a property manager? If the answer is no, you might be okay. If the answer is yes, I do have a property manager, you kind of have to scrutinize it.
Understand. Yeah. As somebody who has set up furniture and dining tables, I can tell you that is no easy task. And that if you are self-managing and those hours can work for you, that is a lot of hours. It is not easy to unbox and put beds together, dining tables, etc. So as somebody who's done that personally on Airbnbs, it is a great way. So great clarification there on self-managing versus not.
Yeah. Yeah. John, I drop back to my material participation slide. You care if I go over that real quick?
I was literally going to ask you to go through this one. I was trying to find
right,
it,
sweet.
the one that you had sent over to us at one point. I was trying to find
Yeah.
it because this is what I was hoping to go through. So thank you for pulling this up.
Yeah, no problem. Yeah. Okay. So we keep saying the term material participation, but what does it actually mean? In effect, you have to meet one of these 7 tests. In reality, most people are going to hit test 1, 2, or 3. And with short-term rentals, in our experience, the majority of people are going to hit test number 3, which is participate 100 hours and more than anyone else. Now, these material participation tests are looked at on a property by property basis. So you have to materially participate in each property separately, unless you make a grouping election, which I'm not going to get into for the sake of time. But you can group everything together and call it essentially one activity for the purposes of evaluating material participation. So let's talk a little bit about number 3, because this is the one that you might see online a lot, especially if you spend any time on TikTok like I do, trying to bust tax influencers. The test is 100 hours and more than anyone else. So first off, in order to even reach 100 hours, that is a significant amount of time. So you really have to plan your short-term rental acquisition and the management afterwards to make sure that you are going to spend enough time on that property, coordinating with the tenants, self-managing it, doing the setup and everything. Like if you can self-manage it, even for the first year of ownership, this is really going to help you hit the 100-hour test. And you can hand it off to a property manager the second year of ownership. That's a little tax hack that we do with our clients. You self-manage year 1 because material participation is looked at on a year-by-year basis. But guess what happens in year 1? You're going to cost seg it and bonus depreciate it. Now that you've stripped out all the depreciation and the corresponding tax benefits, year 2, you hand it back to the property manager, let them manage it. Now it's a passive activity, but you don't care because you already got the tax benefits year 1. Anyway, you self-manage, you do all the setup, you hit 100 hours, great. But it also says, and more than anyone else. So here's the kicker with this. All right. If you get audited, and you go to tax court and you can't prove how much time anyone else spent on your property, you lose. You're now having to hit the 500-hour test. All right. And there's a tax court case that came out in 2021 called Lucero versus Commissioner, where the tax court had a lot of issues with the Lucero's time log anyways. They were already basically like, we don't believe you're credible. But then they opined. They said, okay, but even if we assumed that you were credible, you provided zero evidence as to how much time the local property management guy spent on your property. Therefore, you can't possibly say that you spent 100 hours and more than anyone else because you don't know how much time anyone else spent. So if you're going to hit this test, you have to not only log your time, but you also have to log everyone else's time. My suggestion would be to use smart locks, give everybody a unique code, and then download those CSV files on a continuous basis because you'll have that entry time and the exit time in theory. But you do have to take it seriously, because if you get audited, they will absolutely make you prove that you spent more time than anyone else on the property.
Brandon, a question on that. So a lot of people ask, I've hired a cleaning company, so not necessarily a cleaning gal where she's her own one woman show. If you have a cleaning company, but a lot of cleaning companies, they're rotating cleaners. So, Monday's check-in, it's the same company, but it's Jessica Smith, and Thursday's cleaning is Samantha Jones. Is it the person, or is it the LLC you've hired, even though it's different individual people here? So I want to get into the weeds because this one comes up often.
I want to add to that before you answer it, because I've thought about this before as well. And I was kind of talking through it with somebody, and there's the app called Turno, right? Where you can hire a cleaner to clean your home, and you can pretty much find a new one every single time if you wanted to.
Yeah.
And so then therefore anyone else, you get 20 different cleaners to clean your house, and you're still working more than 100 hours in comparison to that person. So would that also qualify? I know we're kind of getting in the gray areas here, but these are the questions that people want to know, right?
Yeah, these are like level 10 questions, right? So if you're listening to this and you're like, I don't know what that means, it's okay, because this is like a very advanced question, but it's a really good question. So technically, it's participate 100 hours and more than anyone else, and anyone else is any other individual. Okay, so technically, now John, your situation, I would say, 100% you're fine, no issue. Like if you're subcontracting and you're switched up those subcontractors on a consistent basis, no problem. Okay. Now, Taylor, your question was, what if I hired this cleaning company and they like rotate the cleaners out on a consistent basis? Technically, it's any other individual. Now, I'm being cautious here because, to my knowledge, the tax court, I don't believe the tax court has specifically addressed this related to short-term rentals. So conservatively, we would say outwork the cleaners as a whole, but technically it's any other individual.
Got it. Yeah, I think that the same thing rolls into, you hire Bob's Construction GC, and he's got a flooring sub, a painter sub. Flooring might only be 3 days, 8 hours a day. Boom, there's 24 hours. They didn't even get to 100. Bob himself is just the GC. He's not necessarily doing the painting, the flooring, etc. But you did hire Bob's Construction, and they spent, their company or subcontractors spent 150 hours renovating your property. Those are, I think, the things kind of similarly to the cleaner is you have the individual humans who are different, but it's one quote unquote corporation.
I think in that case, though, you're probably fine, because you would be able to show that the subcontracting is going on. It's not Bob's Construction. Yeah. It's Bob. You're contracting with Bob's Construction, but then they're contracting with a whole bunch of other entities and sole props and that type of stuff. I think the risk is if it's like Hall's cleaning crew, and there's 3 people that work at Hall's cleaning crew, and they cycle through your property on an ongoing basis. The question is, would the tax court look at it as, it's Hall's cleaning crew that you have to outperform, or would they look at each individual person on Hall's cleaning crew and say you have to outperform? And I think technically you would be safe. You would say it's any other individual. That's what it says. But that's not going to stop the Internal Revenue Service from saying otherwise necessarily.
Understand. So I like it. Outwork the cleaning company, period, but you still can be safe. And for those who are hiring cleaning companies, I would highly recommend the medium size anyway. When you hire just Hall herself, the risk is she goes on vacation, she gets sick, and she's not available to clean. So the sweet spot we've always found is not going too big where you don't get that level of service, but the cleaning company where there's 8 to 15 subcontractors underneath the gal who runs the org, kind of that sweet spot. And as somebody who's hired them a lot, I can look on my Ring camera and see that like I'm pretty much getting somebody different, because it's just rotational of who's open, who's available, what hours. And so I've seen, a dozen different cleaners circulate through my property personally.
Before we jump over to the next portion of this webinar, I just want this question to be answered, which is asking about if 2 people can qualify for the professional status. It seems to have come up a couple of times, and I think it's a useful one to go through, because there's probably a ton of people on here that are asking, or sorry, that are JV'd together. So if we can talk about, if you're in a partnership, what does that look like?
That is a great question, and I love this question. So if Taylor and I partnered, I was going to say Taylor knows the material participation rules though, so that maybe it doesn't work. Okay, so if Taylor and I partnered and he doesn't know the material participation rules, I know the material participation rules, I've got no problem, right? Because I'm going to spend 100 hours on, and I'm going to be asking Taylor on a monthly basis, hey, how much time did you spend this month? And I'm going to make sure that I outwork him, right? Right? No problem. But if Taylor knows the material participation rules, what happens, right? I work 102 hours, and then Taylor's like, well, I want to work 103 hours. And then I see him, and I'm like, well, I'm going to do 104 hours, right? And you sort of step up until you hit 500 hours in the activity. So our advice to anybody that's JVing or partnering is if both people need the tax benefits, you're looking at 500 hours in the activity
each.
Mm-hmm.
Okay, and that's 3.5 months, you guys, just so you know, of full-time work to be able to hit that 500 hours. I did the math because I was curious of how much.
Yeah, that a boy doing live math.
Yeah. So it's very easy to hit.
10 hours a week with 2 weeks of vacation.
Yeah, exactly. I'm sure there's. Anyways, I'm thinking of something else, but I don't want to say it on this webinar, so we'll save it.
Perfect.
We'll save it. All right. Are we good on the material participation?
Yeah, certainly.
Yeah. Anyone who's watching this, you can come back to this. You can review it. You can review it. You can take a screenshot. This is the one of the most important things here. Okay.
Yeah. Last comment on that too is just like, Taylor kind of mentioned these tax gurus and the influencers, and anybody wanting to sell you something is going to make it seem extremely simple. And you just have to recognize that it's not as simple as it sounds. And even hitting 100 hours is not as simple as it sounds. You'd be surprised how quickly the time passes as you're working on rentals and how short amount of time you can get stuff done in. So just be really careful who you engage with from a tax perspective, and don't push the boundaries with this stuff, because these Section 469 is pretty heavily litigated. And anything that's heavily litigated, there's thousands of audits behind the scenes that never make it to tax court. We've actually started helping recently. We probably get 2 to 3 a month now on Section 469 audits, so real estate professional status and short-term rental loophole stuff that we've been helping new clients with. It's not our clients, but people coming in the front door. You just got to be careful, because we just see the main issues that we see are people don't have a time log. They inflate their hours, they lie, or they use an accountant that doesn't understand it either. So a simple litmus test for whether or not your accountant understands Section 469 is, do they ask for your time log every year, or do they just take your word for it? And if they're just taking your word for it, like if you just say, oh yeah, I'm a real estate pro, or yeah, I spent 100 hours and I outperformed everybody else, no problem, and that's what they take as proof. The problem is that they're doing that most likely with all of their other clients in the same situation. It only takes a couple of those clients to get audited before all of a sudden the audits are no longer random, right? I mean, the IRS has limited resources, so think about it. If I was telling all of my clients, yeah, don't worry, like, yeah, we can count 10 hours for VRBO setup and crap like that. You don't have to give me a time log, don't worry about it. I'm just like saying, yeah, just to appease them because I want your money, right? The IRS comes in and audits Taylor, and they're like, oh, wow, Brandon gave really terrible advice to Taylor. Then they audit another one of my clients to go, oh, wow, now there's a pattern here. He's giving terrible advice to everybody. Let's just pull Brandon's prepare identification number and let's audit everybody. They're not going to go and waste their time like randomly auditing people if they know that they've got a vein of gold. So be careful. Be really careful with your providers.
Wow.
It's probably the best pitch ever.
That that was incredible. I am sitting here going, this makes sense. And you have to think about it. Limited resources. Yeah. Wow. Great.
I want also just to call out, you said a lot of the people who are, telling you it's really easy, they're just kind of saying that to be able to get you to become a client, whereas you're doing the exact opposite. And you guys have 1,300 clients, right?
Yeah.
So like your way is definitely the better way, obviously. But
we lose clients or we lose prospective clients because of it. It's like, you can't work a 2,100 hour job and also qualify as a real estate pro on your one family rental up the street.
And but based off of what you just said, you're protecting all of the other 1,300 clients by not taking on 1 or 2 idiots, right?
That's the idea.
Yeah. Okay. Well, good for you. So let's get into the next stage here. And then we have a bunch of questions that have been coming through. I've been asking everybody to put in their questions, and I'm just going to say it before we get to the next step. Everyone throw in questions right now. We're getting really close to it. We're going to try and rip through as many as we possibly can. We are already almost at 50 minutes, which is wild. because this has absolutely flown by, and we have 83 people who have just stuck here listening to the entire time, Brandon. So appreciate it. Let's get to this next step. Taylor, I'm going to let you take this one away.
Yeah. So guys, walking through the STR transaction, you're going to have opportunities along the way. So I like to say, when you are looking at this realistically and not inflating that it takes 10 hours to set up your VRBO account, it's kind of death by 1,000 cuts. You're going to accumulate your 100 hours kind of in little, bite-sized pieces here. So when we're working with a client who wants to buy a cash flowing short-term rental, game plan and strategy are going to start with, what are your budget and preferences? So how much cash do you have and what do you like, what do you not like? It's going to obviously determine what market you go to, what type of house you buy, and everything from there. So once you hone in on those two things, you can narrow down a market, you can acquire a property, you'll have the construction and design section. So getting it renovated, getting it designed to get ready to go. Once you get it live, you're going to have the operational section. So you're managing the Airbnb, you're getting everything needed from a material participation standpoint. Once it's up and going, then you'll order a cost segregation study. This will give you the amount of depreciation, bonus depreciation, that you can then hand off to your CPA, such as Brandon and his firm. So from there, that'll unlock the total tax benefit that you'll get when it comes time for tax filing season. So for those of you sitting here going, man, it's August 22nd, 2024. Can I still make it happen? And if we do a little reverse engineering, the answer is yes. We are cutting it super close at this point, and obviously nothing is guaranteed. However, our firm at STR Search can definitely help you find, identify, narrow down a cash flowing opportunity based on your budget and preferences, get you that Airbnb, and then from there, you can make sure to collect your hours, get the material participation. It needs to go in service this year. Again, it's not when you buy it, but when it goes in service. Brandon would be the first one to tell you that. I have learned that very quickly when diving into this stuff. So guys, there is still time. It is running out. Like John said, the time is coming up very quickly. So if you are still wanting to take advantage for 2024, time is of the essence.
Yeah. And just want to kind of, Brandon, have you walk through this just for clarification, right? Because we've talked about a lot of different things, but I think that this really nicely lays out each different stage that people are going to go through, other than maybe the first one there, but all the other ones are pretty much stages that they have to go through. Which ones, just at a high level, doesn't have to be perfect, can people qualify for the material participation, and which ones can they not as they're going through?
I think that when you are, the more due diligence related it is, you're going to be looking at those investor level hours. So the lower down this totem pole, if you will, the better the hours are going to be. So operations is clearly, that type of time is going to count for material participation. Construction is going to count. Design could not count, depending on if you are going to be self-managing or not. So it really depends on in acquisition and market selection. All that type of stuff is going to be investor level hours. So if you self-manage and you're the one that's running the day-to-day, then that time can count. But a lot of people will get a property manager, even if it's like a condo association and they have a little manager, then you are at risk of all those hours not counting.
Great.
Okay. And when would somebody, when do you recommend somebody reaches out to a CPA firm such as yourself? When they're considering to do this before they buy the property, like what's the best time?
Yeah, I would definitely say, I mean, I guess it depends on what you're trying to do investment wise, but the sooner the better. If you reach out to us prior to putting an offer in, we can help you understand the tax benefits and whether or not those tax benefits should influence the type of offer you make or what markets you're looking at. Like you might pick a market that's a little bit more local to you, for example. You might pick a property that can produce higher amounts of depreciation if you understand what the tax benefits are prior to going through that offer. So I would say our clients that come to us prior to the purchase tend to have better results. Even if the results are like, this isn't something I'm going to do, at least they go into it knowing that. Versus I picked up 2 short-term rentals this year, heard about the short-term rental loophole. Now I want you guys to help me report it and we find issues. That's always a bad deal. So yeah, sooner the better.
Okay. And we are pretty well at time here, and I can already see that we're having quite a few people dropping off as we're going. They're probably getting back to work or heading into their next call. So I want to be able to leave these two up here for anyone who, wants to reach out to Brandon Hall. You can pull out your phone right now, scan that QR code. Even if you don't want to hire Brandon Hall, just at least pull it out and scan it so you have his information. And if you need to ask him a question, or maybe a year or two down the road, when you do end up buying a short-term rental, you're kind of ready to go and you know who to reach out to. And then obviously you can reach out to us as well for the property finder service, right? That's what I do extraordinarily well. Taylor and I do that really, really well. We find profitable cash flowing properties, and then you can go over to Brandon Hall to get those, take advantage of the STR tax loophole, right? So you have both of those options right there. And then, screenshot this if you need to. Come back to this. This whole video is going to be on YouTube, so you can go through this if you need to as well. But I do want to make sure that anybody who is still on this call can get the free training. So I'm going to jump over that in just a second. I'm going to do this in about 10 seconds. So if you're in the middle of scanning this QR code right now, you've got about 5 more seconds before I'm going to hop off, and then we're going to jump over to the next QR code. Okay, and then we're going to get into the Q&A, which we'll do for about maybe 5 to 10 minutes. Does that work for you, Brandon?
Yeah, it's fine.
Okay, awesome. All right, here is the free 4-day email training. I love this, by the way. I've seen this a few different times now, and I think we're actually going to take a lot of we have 6 free courses, and it's about 50 to 60 hours worth of training. So it's an outrageous amount of information. And it's all just kind of there, right? And so if people go to it, they can do it, but we need to like almost organize it and kind of walk people through it. So I love this 4-day training because it allows them to more easily consume the information. So love that. Love that you put it together. Thank you for, giving this to everybody. Of course, guys, pull out your phone and take advantage of this. Brandon, do you want to explain to people what they're going to get here? And then we'll jump over to the questions.
Yeah, so whenever you sign up with your email, you'll immediately get an email. That's that day one email. And it's got a lot of links to the various content that we've created that will just help you build a fundamental understanding of how taxes related to real estate work. I would say that it's really good for anybody that's brand new to this stuff. It's also good for anybody that is pretty experienced. You're going to find something even on that day one email that will help you understand some nuance a little bit better. The second day is a training that I actually used to do, and I just recorded it. So it'll actually kick you out to my YouTube channel. And it's just on the passive activity loss rule. So it's kind of what we did today, but much more in depth. So you might get more of your questions answered. And then day 3 and 4 are just additional good content.
Perfect. All right. Let's hop into the questions. I'm going to leave these two up here, guys. If you want to be able to, once again, pull your phone and reach out to either of us, you have that option. But let's get into some of the questions. Taylor, do you have the ability to click any of these and bring them to screen? Do you know? And Brandon, if you do as well, by all means, go for it. I'm going to just pull up this one to start. What happens if you acquire the property mid-year? Is it still 500 hours minimum?
Good question. There is no proration of hours. So you could acquire it on December 31st or January 1st or June 15th. You still have to hit the 100 hours, 500 hours. Yeah, you don't get to prorate it.
Okay. And then this one is a good follow-up. So if you hit the 100 hours, the average stay is under 7 days. Is there a minimum length of operation or minimum number of stays needed? I.e., if I start renting out a place in late November and have 3 guests stay in 2024, is that still okay?
Yeah, that's a great question too. Our recommendation would be to have at least 2 or 3 stays, just so that you can calculate an average. If you have 0 stays, you can't. We would not be comfortable claiming this as a short-term rental for you if you had 0 stays. And if you had 1 stay, we're still probably pretty uncomfortable claiming that as well. So yeah, you would want to be looking at least 2 or 3 stays. And just a quick caveat, because I saw this one time. When we're talking about a stay, you actually have to have somebody stay at your property. So like I saw this in an investor group one time. Basically be like I contact Taylor and I go, hey, you buy 3 days at my Airbnb and I'll buy 3 days at your Airbnb. And it's just like you guys would be surprised how quickly the IRS can actually find that type of stuff. So just don't play games. Yeah, 2 to 3 stays I think is better.
Yeah, I'm just gonna stress to everybody right now, because this is what we do for a living. There are, I think it's like 19 weeks left in the year, 18 weeks, something like that. And one of our clients, it took them 17 weeks to go from starting to talk to us and then getting that property live. And we have other clients that are taking longer. A rule, I'm talking to you right now, and I hope to God you can get that property up and running. But the reality is that it can take 17 weeks or longer to get it done properly. So the time is getting really, really short to get that property done properly and actually be able to get the guests in there. Otherwise, you're going to have to just buy it, throw furniture in there as quick as you possibly can, get it up on Airbnb, get some guests in there to actually like do this properly with enough time frame for Brandon to actually do this, or you're going to have to push over to the next year. So just keep that in mind. Time is running out. We're at like, again, 18, 19 weeks, something like that. I've got a ton of questions because I asked people to put questions in as we were going through. Some of them have been answered. Some of them have not. They're kind of, I'm trying to keep them on the same topic as I go through, but they're all over the place. So I'm just going to throw up new ones, and Brandon, you can kind of take it from there.
All right. So my short-term rental is 1 hour, 15 minutes away. I go between guests to inspect, collect bedspreads to wash. It's a good one. I was hoping nobody's going to ask me that one. That's a pretty gray area at this point, and I say it's gray only because we haven't really had any clear guidance from the tax court. If you are truly going there every single week and you're turning the unit over, you're doing the repairs, I think that you would have an argument to count that travel. Now, if you have somebody else that's doing a lot of the turnover for you and you're just traveling just to log hours, then you would not have an argument to count that travel. So it kind of just depends on exactly what are you doing at the rental. But if you're truly doing everything top to bottom and you're doing it every turnover every week, then I think that you have a decent argument. Yeah.
This one is asking, the actual time spent calling landscapers, cleaners, etc. Does that count towards the hours?
It does. Yeah. I mean, the time spent like coordinating your contract labor to get to the house can absolutely count. But you have to remember, tax court judges do not live in a bubble. And that is ultimately who we are trying to convince that we are truthful, right? So don't put on your time log that it took me 2 hours to call my landscaper because, everybody knows that's BS. All right. But if you want to put 0.1, it took me 6 minutes to text or call my landscaper. Okay, that's fine. Yeah, absolutely.
Okay, perfect. Next one here is how to qualify for material participation if you have a property manager. I know we touched on some of these questions already. We're just going to kind of hit them again just because I'm sure they're top of mind for quite a few people.
So how to qualify as for material participation if you have a property manager, it's going to be really hard to do. The only times that we see people qualify, hit material participation with a property manager is if they are the GC and there's a big construction project that they're running themselves. And not even that they're like subbing out a lot. I mean, they're doing a lot of the work themselves, right? Or I'm splitting duties with my property manager. But if you're going to split duties with your property manager, you also have to reflect that in your property manager contract, because you can tell the IRS and the tax court, hey, they do this and I do that. But the first thing they're going to do is look at the actual contract. And if the contract says that the PM does everything that you're doing, then they're going to believe the contract. They're not going to believe you. So you have to actually solidify those roles and responsibilities if you're trying to split duties. The third way we've seen people materially participate, even when they have property managers, is just on large portfolios. But I'm talking like 50, 70, 100 properties. Like it's your full-time job at that point, and you have a bunch of subcontractors, property managers that help you with the day-to-day. That's a different scenario as well. Otherwise, it's going to be pretty challenging to materially participate if you have a property manager. And the IRS Audit Technique Guide, by the way, will say you cannot materially participate with a property manager. So that's the frame that the IRS agents will audit you from. So they believe you are lying from day one, and it just means you have an uphill battle.
Never a good start.
Yeah.
People are wondering if you're taking on new clients.
Yeah, we're always taking on new clients. You can scan that code, and I think there's like a big "Let's get started" button at the top. You just got to fill out, the web form. But yeah, if you go to therealestatecpa.com, fill out the web form. Our team's happy to chat with you. We're kind of unique in the sense that we don't really like fill up from a client perspective. We figure out what the demand is in the market, we get the talent in the door, and we just always make sure that we can support whatever's coming in. So yeah,
must be nice because we fill up. So there are only so many good properties out there, and we're getting to the point where we're at capacity. So Same thing goes for us, guys. Shameless plug. Go to that QR code and schedule a call with somebody on the team to learn a little bit more about what we do. But let's keep ripping the questions here. Are there any additional tax benefits closing in an LLC versus your personal name?
No.
Okay. What was that about condo HOAs and material participation?
Yeah, some condos just like manage like when you buy in a condo, you have to look at what does the condo management look like. So some condos will actually check your guests in and check them out. They'll manage the gate codes and parking and all that type of stuff. And the more that they do, the less likely you can qualify for material participation.
Okay. Will this video be on YouTube? This is currently live on YouTube, so you will be able to find it on YouTube. Just letting you guys know. Next one is I purchased my STR. By the way, Allison is one of my favorite human beings, so she's the best. I purchased my STR property in December of 2023, but it went live February 2024. When can I complete a cost seg study? Do I start that process now or early next year?
You just have to do the cost seg study before you file your 2024 tax return. So that's April 15th, 2025. Or October 15th, 2025, if you have an extension.
Brandon, correct me if I'm wrong too. Can't you cost seg if you had something go into service in a previous year? You can order a cost segregation, I believe, is it 3 years backwards or 5 years? Obviously, you'd be amending your taxes. Your CPA might not love you, but I think I'm in the right breath there, correct?
Yeah. If your CPA doesn't love you for that, then find a new CPA. We love that stuff. It's
Perfect.
it's extremely complex, and it's great because we help the client and we also make more money. So, you can retroactively cost seg up for really forever. You can even sell the property and then 5 years later cost seg the property that you don't have. I mean, you wouldn't have any benefits, but in theory, you could do that. So yeah, you can cost seg retroactively whenever you want to if you miss it the first year, which is actually, Taylor, I'm glad you asked that question because there is sometimes we will get into engagements with clients and we'll realize through our consulting, like, hey, you don't qualify as a real estate pro this year. So instead of getting the cost seg and everything done, why don't we just wait until the year that you will qualify as a real estate pro? Might be 3-4 years later, but you quit your job, you go on a sabbatical or whatever, and then you do the cost seg study in that year that you're a real estate pro. You retroactively cost seg your entire portfolio. And now all those losses would be non-passive. So you can absolutely time the cost seg study. It does not have to be the first year. It's a great question.
Guys, this is what I love is a CPA who plays offense versus CPA who plays defense. And I've said this before is these are proactive approaches to maximize and optimize your tax rather than you hand your docs to your CPA and they just package them. There is no offense. And so if you want to play offense against your tax situation, your tax bill, you need a CPA who is playing offense with you, not somebody playing defense who is just taking in those docs and replying to the IRS.
So there's a lot of other things related to short-term rentals too. I know this is a short-term rental webinar. So like there's so many cool things related to short-term rentals aside from the first year of ownership that we see a lot of mistakes on. Like it's 39-year property, so it's depreciated over 39 years, not 27 and a half years like most rentals. But with the 39 years, you also get to bonus depreciate qualified improvement property, which is any interior enhancement that's not structural. So think about that. That's a lot that you can immediately bonus depreciate. You can also Section 179 roofs, HVACs, fire systems. So like I just replaced the HVAC on my beach rental, and I'm Section 179ing that, which means that I get to immediately deduct the entire cost of the HVAC. So there's some cool benefits related to short-term rentals. And if you have short-term rentals and you're listening to this and you're like, my accountant has never told me any of that, told me anything there, you might just want to get a second opinion. Because depreciation, cost seg studies, bonus depreciation gets all of the attention, and it is awesome. But to truly optimize on an ongoing perspective, you really have to know how the 2013 TPR, tangible property regulations, apply, and you have to be aware of the CARES Act and all these other things that kind of factor in there. So,
So I'm gonna go back for a second here, and I'm gonna be the dumbest person in the room. Because I have heard about this idea of like retroactively, 5 doing a cost segregation and saving on your taxes. I thought I understood it. I asked some people about it. They're like, that makes no sense. Can you explain that as if I were to be a 2-year-old, like a 5th grader, and and kind of make it make sense for me?
Yeah. So let's say you buy a short-term rental this year, and for whatever reason, you're not able to materially participate, or you just don't want to take the risk. Maybe it's close, but you're like, you know what, I just don't want to take the risk this year. Next year, though, maybe this year you had a baby, and it's life at home is hectic and it's crazy, and you're just not able to spend as much time as you thought you would on the short-term rental. Next year, it's a little bit more chill, so now you can dedicate some time to it. So you kick your property manager out, you start self-managing the rental, you hit the 100-hour test more than anyone else, so you're materially participating in short-term rental. You can cost segregate the property next year, and you can apply the depreciation to next year. You don't have to apply it to the year of acquisition. That's what it means. You have to file some extra forms. Like I said, it's complicated, but you can absolutely get something like that done.
I'm going to explain it back to you and make sure I understand it, right? Let's hypothetically say in year 1, I do a cost segregation, but I do not qualify for the material participation. And so then you tell me, hey, we're not going to use this depreciation against your taxes. Then the next year, we're gonna kind of hold on to it and wait till you actually need it. And then the next year, I do meet the material participation, and I have those tax savings sitting from last year, which you then apply to my current tax years or my current taxes for the year.
Yes, one tweak. We would tell you don't get the cost seg study until the year that you're going to apply that depreciation. Because if you do it this year, and then we're not going to use it this year, we're going to use it next year, we're going to tell you have to get a new cost seg study to account for inflation and all that type of stuff, right? So these guys have models that they're segregating your components against, and they change on an ongoing basis. So we want the most recent in that year. But the cool thing is that if your CPA does this a lot, they'll be able to help you estimate pretty accurately what the cost seg would look like. So you can talk to them before you spend the money on the cost seg study. Everything else you said, though, is correct.
Okay. And so I should not order a cost segregation until I know that I'm going to be able to meet the material participation.
Right.
Okay. Yeah. Perfect.
And you can do it retroactively, right? So like kind of it was Allison's question.
Yep.
Just because you bought the property, in December 2023, or it went live. It was placed into service in February 2024. A lot of people, and especially people that get cost segregation sales messages, because cost seg guys are always like, oh, it's December, you have to get it right this second, otherwise you lose. But they're trying to meet their sales objectives, right? So you don't have to do that. Just because you put the property into service in February 2024 does not mean it's a dead sprint to go get a cost seg study. You have until April 15th, 2025. So you can have a conversation with your CPA in January of 2025, reflect on the year, and say, I participated this way and that way and that way. And then should I get a cost seg study? You don't have to get it in the year that you acquire it.
Okay. I think we're going to wrap it up right then there, guys. There was some other questions.
I have one more because I saw this and I said that I was going to talk about it. It's depreciation recapture.
Yes.
Which one? Who asked that question?
No. He brought that up. That's that you take. If you take from the government, they will take it back if you do not follow protocol.
Okay.
Yes.
Thank you.
Yes.
Thank you.
So sorry that everybody has to stay a couple more minutes and listen to me.
No. I'm totally fine.
Just vomit tax stuff. So depreciation recapture. Absolutely right. The question was, don't you have to pay it all back? Yes, you do. Whenever you take depreciation, it's a current year tax benefit. In theory, if you invest that tax benefit, then by the time that you sell the property, it's not going to matter because you have to pay back the tax benefit that you originally took. But if you've invested it from day one, then it's grown in value and all that type of stuff, right? Here's the problem. The problem is when you buy property in Joshua Tree or you buy property in the Smokies and you rode that Airbnb wave, right? The 2020, 2021 buying frenzy where everything was top dollar. And you justified your purchase by, I'll get the bonus depreciate this thing and get a big tax benefit. So I'll go ahead and purchase that. So let's say that you bought it for $1 million and today you can sell it for $900,000. Most people, before they ever experience something like this, most people would say, I bought it for 100, I sold it for 900, so I have a $100,000 loss. That sucks, but I just got to get rid of this property. I'll take that hit. But here's the problem. if I bought the property for $1 million and I took depreciation of, let's just call it 250, the adjusted basis of the property is now $750K. So when I sell it for 900, I actually have $150,000 gain, and that is taxable. Okay. So these folks that, like, when I say make sure that you're buying for wealth building, taxes are all secondary. You can't use the tax savings as a justification to make the purchase. It should be a cherry on top. It should be like, oh, wow, I had no idea that could happen too. That's great, right? If you're underwriting this into your models, you will set yourself up for massive failure.
I heard you say that on your YouTube video. The tax savings is a cherry on top, and I was like, I love this guy, because I've said that to so many people. It blows my mind how many. Again, I said this already. This is my second time saying it, but the amount of rich people that want to take advantage of this, and they just go and buy whatever, and the objective is just to break even, so I can take advantage of the tax loophole. I'm like, we've even had people say, like, yeah, I'm okay with losing $1,000 a month, and it's like, you don't have to, right? Like, why would you do that? You don't have to, right? And so, anyways, shameless plug one more time. That's what we do best, guys. You can hire us and we can just find your property that cash flows. We have a 100% success rate over 180 properties in 2.5 years. So we're pretty damn good at this. So if you don't want to lose money and you also want to take advantage of the tax savings, just give us a call. It's really that easy. But Brandon, anything else you want to mention here?
That's it. I appreciate everybody that stayed till the end, and thank you guys for having me on.
No, you
learned a ton,
absolutely
man.
crushed it, man. This was amazing.
Thanks.
The amount of people that stayed on the entire time was extremely impressive. So
Good.
Thank you, everybody that showed up. Everyone show Brandon some love in the comments. We might have to do this again and just go at it one more time, because this was very, very good. All right, guys. Thank you for being here. We really appreciate it, and I'll see you later.
Thanks, everyone.